Welcome back to Everything Money. In this video, we will talk about Microsoft. We'll give you a stock update. We will show you the financials and do a fundamental analysis using our software. We'll show you the numbers. We will translate these numbers into what you should be paying for Microsoft moving forward. We'll use our stock analyzer tool and show a 7-year progression. If you're looking to trade Microsoft at a quicker pace, we will head over to Mo. He'll show you all the charts, all the trends, and you can trade this puppy in our Bid and Ask Nation. But first, why should you watch this video? I bring your questions about Microsoft to a couple guys that own and operate over $100 million in businesses, stocks, and real estate all over the world, and they will give us a mindset about investing in a company like this. I give you Paul Gabriel.
Thank you, Seth. First off, follow us on Instagram, Everything Money Investing.
Yes.
And then also follow our personal accounts, but don't try to spoof us like somebody's trying to do right now. What's going on with that, Mo?
Don't hack me.
Somebody's trying to hack you? All right, so Microsoft, guys.
Tell me about it.
So Microsoft is interesting. I have some interesting stats on Microsoft that I want to bring up because it pertains to the value investing world. Back in 2011, 12, 13, I was a big fan of Microsoft. And all these tech guys were telling me how stupid I was. Got it. So here's the interesting part. If they had heard this stat, they would have said, see, Paul, I told you. Currently, 73% of PCs have Microsoft Office or
Today?
Windows today
73.
on them. What was it back in 2013?
20%. 50%.
Sorry, what percentage of PCs used Windows? Today it's 73%. What was it in 2013?
Oh, PCs use
45%.
What? Can you pick a number instead of just spitting out
45.
45%. What's your guess?
whatever Mo says.
45%? It was 91%.
Whoa.
91 of PCs.
Back then, 2013, had Windows as their operating system. Today, it's 73%.
I thought it would have gone.
So I told you that stat back in 2013. You'd have said, "Oh, Microsoft's dead. Confirmed. It's done."
Yeah.
Now let's go to our software, our exclusive Everything Money software. We'll go to the tools for 8 pillars. We'll type in Microsoft. Here's the stock price. 2013. It ended the year at $37. It's currently $337.
10x, yeah.
So 9 times.
Yeah.
Sorry, Paul. You're right.
9 times Minican. 9 times the growth. Why? Cloud computing, Office 365 subscriptions, all these other things that happened. We talk about this with Intel, for example. Intel, if I tell you that Intel is going to lose market share, the big driver of Microsoft was Windows. But guys, a company that's dying, if bought at the right price, it has other future potential in other businesses, can still kill it. And I was literally ridiculed by tech executives saying how stupid I was. The stupid thing I did was sell Microsoft at $55 and $60 thinking it was overpriced. But I bought it at high teens, low 20s, right? The stupid thing I did was get rid of it, not seeing the potential of it. So anyways, let's get into the analysis. But I just want everybody to remember that they lost 20%, literally 20%. 91 to 73 is 18%. Literally lost 20% of their market share on PCs having Windows products.
Well, not literally.
Yeah, it was 91 to 18. That 73 is 18%. What's 20% of 91?
Oh, wow. You're so wise.
I'll take the apology now.
Let me cue that up here.
All right, guys.
Market cap.
Microsoft is the biggest company in the world, market cap wise, $2.5 trillion. Pillar number 1, we want price to earnings over the last 5 years to be under 22.5. It's currently 63, a shade high. That's an X. Pillar number 2, we want the return on invested capital. This is the cash flow return we're getting on the equity and debt invested in the business to be greater than 9%. It is 17.5%. Massive check mark there. So they do a great job of getting a good cash flow return on the money invested in the business. Now, Uncle Seth.
Cute dividend.
There is a cute dividend of 0.7%. And this is largely skewed by the market cap. As the stock goes higher and higher, the dividend yield goes lower and lower, right? They currently pay $17 billion out of their free cash flow towards dividend. Now, for those of you Everything Money students, understand that a dividend is not always secure. You have to look at the free cash flow. That's why I put it up here right above that to make it easy for our users. The last 5 years, they've averaged 43 billion in free cash flow, and last year they did 60 billion. I am not worried about this dividend at all. Zero concern. So far, 1X and 1 check.
Pillar number 3 is revenue growth, Paul. I'm sure they're slaying it.
Right? So we go to the income statement on the Everything Money exclusive software. We scroll down just a little bit, 99 billion to 176 billion. When I gave you that stat before,
A chickadee check.
they did 80 billion when I gave you that stat. Over doubled. So they lost that much market share of their PC operating system.
Literally 20%.
And they've over doubled their
Jeez
revenue.
Louise.
So that's a check mark there, folks. Pillar number 4,
Profit growth.
net income or profit growth of the last 5 years. They did 26 billion to 68 billion.
Come on.
Massive check mark there. All right, pillar number 5. This is the silent killer, guys. This is what I want you to pay attention to. Shares outstanding. If a company is increasing its shares outstanding, they are diluting you as an owner. Now, if the company is very expensive and overpriced, it's okay to issue shares instead of taking on debt to raise capital. But if it's underpriced, if it's undervalued, you want them buying shares back. So we go to the bottom of our income statement on our exclusive software. We go to 5 years ago, 7.71 billion, and now 7.51. So they are buying back shares. Now, I will say, they're a very expensive company. So I don't like the idea that they're buying back their shares because they're essentially overpaying for their own stock. But it's not a huge number, so I'm not going to cry about it. I'm not going to worry about it. Pillar number 6. Seth, what do we always talk about?
You cry about a lot of things, but not
I really do,
shares
actually.
Outstanding.
I do cry about a lot of things.
Pillar number 6 is total long-term liabilities divided by their 5-year free cash flow. It involves their debt. Tell us, Paul.
Right. So, guys, just like your personal life, a company with less debt is going to do better in the long run. They're going to withstand recessions, pullbacks in the business, etc. So what we do is we look at the main page of our software. We go to the 5-year average free cash flow, 42.5. We multiply it by 5, and that is roughly $212.6 billion right here. I want to be exact since Seth is calling me out on stuff. We want their long-term liabilities to be under $212.6 billion. Is that accurate?
It's 212.5.
42.52 times.
I didn't put the 2 in, so you
Oh,
probably
see, I
got it.
did. I included that.
Go. Look at you go.
I'm just saying. So 212.6 billion. So what do? We go to the balance sheet. We scroll up to the top,
Please do.
go to the balance sheet, scroll all the way to the bottom, 102.9. Check mark there, guys. Massive check mark. And go back just 10 quarters to 2019, they had 114 billion. So they're paying down their debt nicely. Even though interest rates are very low, they could easily have a lot of long-term debt at very low cost. Okay, pillar number 7, the big mamma jamma of all big mamma jammas. We go to the cash flow statement on our software, kids. Free cash flow. We want to see free cash flow growth. Seth is going to explain to you now what free cash flow is and what you can do, the 5 things you can do with free cash flow.
Paul has taught me that free cash flow is cash from operations minus capital expenditures.
Yep.
And you can pay dividends, you can pay down debt, you can pay and make acquisitions, you can buy back shares or reinvest in yourself and build new buildings and all this stuff.
I am a converter to
Islam?
I'm very impressed, Seth. So Seth got all 5 correct. Now, on our software in the cash flow statement, it's cash from operations, like Seth said, minus your capital expenditures. Now, we have added the free cash flow line to this cash flow statement to make it easy for you.
You normally say you.
I know, I do say that, but I'm saying we now to be more
Nice
inclusive.
of you. Really wasn't involved, but I appreciate it.
Yeah, you weren't involved, but you're still a pretty face. So 32.3 billion to 60.4 billion. That's a massive check mark, guys. Our final metric is we want to come up with some sort of estimated value for the company to look at.
Like we're buying the company as a whole. Paul.
Yes. Now remember, this is not set in stone. It's kind of like a starting point. Just like the 5-year PE being below 22.5, we want to take the 5-year average free cash flow. We should multiply it by 22.5. I just haven't done it because I'm completely lazy. 42.5 times 20. That is roughly $850 billion.
Oh boy.
Now,
Yep.
remember, the market cap is 2.5 trillion. This is a big X. Big X, guys. This is 3 times overpriced. Now, I will say this. 1, if the company has great growth potential, in the last year, their revenue, I'll pull up for you right now. Revenue growth was 22% year over year versus 19% expected. Cloud market share has doubled in the last 3 years, and cloud is a very, very high margin business. But there are 3 major competitors to cloud: Oracle, Google, and Amazon. Amazon is the biggest, and I think they have 36% of the market. Microsoft 365 has 54 million subscribers. Microsoft Teams has 250 million active monthly users. LinkedIn has 800 million members.
Jeez.
And Windows 10 has 1.3 billion monthly active devices.
This is how weird Microsoft is. I don't even know what 365 is, but when you said it, I just realized I use it through one of my companies. I didn't even think about it.
Yeah, it's a monthly subscription to use all their software. It's phenomenal. So instead of buying Microsoft Office for $400 like you had to before, you just pay freaking $8 a month and you get all their things for unlimited use, and you get all the updates, etc. Businesses are becoming more monthly subscription based. So are we. Do you like how I did that? So are we.
That was very effeminate.
So Microsoft is starting to transition more and more into the monthly subscription model. Their revenue is increasing that way. Okay? So if you want this recap, guys, without doing much work, if you want to be lazy like us, go to the 8 Pillars tab. Because I'm lazy, I wanted to make this tab for myself as well. And Uncle Seth, what do we have here?
Yeah, valuation is just overpriced.
Now, remember, the company we want $850 billion market cap is $2.5 trillion. Take 16 divided by 3. What do you get?
Yep, 20 market. 20 multiple and 20 PE. Yeah, sure.
So it looks at now. The question becomes: is this a reasonable value to pay? Well, we have the stock analyzer tool. So, all right, guys. So we can take these assumptions and put them into our stock analyzer tool. For those of you who think you're going crazy, we just went from light background to dark background to make it easier for you guys to view. So you're not losing your mind. Okay, so. We first start with how many years of analysis. I always like to do 10. You can do 1 to 20. I do 10. And I have 3 assumptions. You can do 1, 2, or 3. So now, here are the numbers over the last 1, 5, and 10 years on the revenue growth, all these things. Now, let's start going through it. So, Uncle Mo, give me you want to do like 87% revenue growth for our low?
So, 88. But did you look at the acquisitions that they make a lot of acquisitions?
Of course, Microsoft does a ton of acquisitions.
So that's why when I look at Stock Analyzer,
are they big acquisitions?
Well, it's all relative, right? I mean, let's see, we have 9.6 billion, 2.5 billion, 2.6 billion, 1 billion, 26 billion. So
26 billion, huh?
Yeah,
that was probably LinkedIn.
Mm-hmm. So.
Paul, you always say
8, 10, 12?
Yeah, these big companies, they can't grow.
I like those numbers, yeah.
But they're currently doing it. So,
well, their revenue growth is actually increasing over the last 10 years. And I do think with not only that, I do think with the cloud computing, the market for cloud computing is growing like crazy. So I think they can grow that revenue pretty nicely.
Yeah.
Maybe do 6, 8, 10 just to be conservative. Let's just be a little conservative. Guys, our goal here is to be conservative. There's 10,000 stocks out there. We want to find 20 to 40 that are growing or that have the numbers that hit our metrics. But we want to be conservative and then find the ones that are still underneath that. So let's start with 6, 8, 10 and then go to the 8, 10, 12. How about 7, 9, 11?
Sure. Split the difference.
Let's split the difference. Okay.
So when it comes to profit margin,
yeah,
a lot of what they're doing is going to be cloud-based. So we can either go conservative or not.
So here's the deal with cloud-based. I agree with you. Cloud-based is very high margin. However, with more margin and bigger competition, what happens to margin?
It goes down.
It tends to decrease. However, I do think their margin is increasing, so I think we can go somewhere in between these numbers. So give me some numbers.
25, 27, 29.
Okay. Free cash flow margin.
Probably the same.
Even their free cash flow was higher for some reason.
Yeah.
All right, PE.
12, 14, 16.
12?
Well, they're a $2.5 trillion company.
Okay.
I just don't.
Well, the revenue I would look at. So
I don't think they can. Yeah.
The revenue is 170 billion already. Is going to grow. Here's the deal. We're going to start with these numbers. And then we'll go put some more aggressive numbers in. We hit the analyze button, guys, and we always do 12.5% return because you can invest in an ETF and get 9 or 10%. So if you want to invest in an individual company and you want to have a margin of safety, put in 12.5%. Analyze, the company's currently at 337, and we're at 87 on the low end, 160 on the high end with a middle of 120 or so.
This is what you need to pay to get the desired return.
To get the 12.5% return.
Yeah.
So let's go be a little more aggressive above. Let's go to 8, 10, 12. Let's do margin of 27, 29, 31. And let's do 14, 16, 18. Now, the reason I do this is I want to show people how overpriced this company really is. I went and did higher revenue growth, higher margin, and higher multiple. We have a low of 109, a high of basically 200, and a middle of 150. Guys, we're still massively overpriced. This company is currently at 337. So you have to sit there and ask yourself, okay, let's go higher. Let's sit there and say they do 10, 12, 14. Now on the middle range of 12%, guys, that means in 10 years, they will do $545 billion in revenue.
This year they did 175.
So what did they do 10 years ago?
Income statement.
72.
72, yeah.
So they would have a bigger growth percentage-wise over the next 10 years.
That seems unlikely.
It seems harder to go from 175 to 500 whatever billion than it does to go from 72 to 176. That's my whole entire argument here.
Right.
But let's assume that in there. Analyze button, it's still not even close. It's still 126, 170, and 226. So guys, Microsoft's just overpriced. Now, why did we create this software? This has been extremely popular. Stock Analyzer tool has been so popular with other users. And the reason is we were doing these on Excel and our users wanted a way to look at their own companies and to be able to analyze their own deals without waiting for us to make videos on it. So we made the software. We invested hundreds of thousands. With the software, you get everything you saw here. You get it all on your iOS or Android device, either one. You get everything on there. You get the Stock Analyzer tool. You get all of these tools right here, plus all the ones that are coming. There's more adding. We're adding news. We have exclusive daily content, 2 or 3 videos a day from Seth Moe and I. You also get access to Seth Moe and I. You also get access to our community. There's over 6,000 people who currently subscribe to the software. They're in a group, in a big chat with lots of different rooms discussing tons of topics, including crypto and Tesla and other hype stocks you guys might love. There's trading. There's Mo with the trading. You get all of this for only 90 cents per day. 90 cents per day. If you're serious about your financial future, if you either save or increase your returns by 1 or 2% a year, or decrease your losses by 1 or 2% a year, it could lead to hundreds of thousands, if not millions of dollars in extra gains in the long run, and it's only 90 cents per day. 2 ways to sign up, everythingmoney.com or Patreon. Either one gets access within minutes. The benefit of everythingmoney.com is you don't pay sales tax yet because they're not large enough, so sign up now, only 90 cents per day.
If you are looking to trade Microsoft at a quicker pace, we will look at the charts and trends right now with that handsome Egyptian dreamboat that is Mustafa Hussein.
So I'm going to pull up the daily chart, a little more detail, but the reason I do that is I want to show you that we are over all 4 major moving averages approaching this all-time high that was actually made yesterday, but it's fallen back today. So with that being said, it's a power stock. What is a power stock? It's a stock that you are over all 4 major moving averages that I just showed you. Your stochastic is at the top right here, and you're making new all-time highs. So this has been a hell of a trade. I mean, this has been incredible. This is exactly a power stock that you want to see. You want to see a stock that goes through the sweet spot way back here, and it basically stays in that overbought area as the stock price just keeps climbing and climbing. So right now, if you're in this, consider taking profits up here for no other reason that you're at a top. We're getting into the holiday season. I think this is a good time to take profits. If you're not in this yet, I wouldn't get into it. What I would do is come over here, back to the daily chart, and just play with it. You can certainly get a little bit of a short out of this. If this keeps falling, it'll probably fall maybe to the 50-day moving average and bounce right up. You'll just follow your stochastic down and follow it right back up. There's different ways to approach this. Now, day trading. There's times that you can get into this from a day trading perspective, but this is a very, very slow moving stock. I do not think that I would waste my time doing a day trade on something like this. Go find something that's a little bit more volatile on a day-to-day basis, and it'll be much better for you in the long run. So if you like these rules and you want to have a process like this, come and join me in the Bid and Ask Nation. You get my Trading 101 series. All the rules that I just talked about, that's the place to go for it. The Employed Trader series, which is 6 stocks that I run through every single day and give you an update on. My monthly seminars and a Discord community of 900 people. Come and join me.
You're saying in the overbought region, Mo. I'm not going to add at any point, but I like being in there and letting it run until the stochastic flips. Yeah,
so what we like doing is catching it down here or catching a sweet spot reversal, because this, remember, in the sweet spot is your cookie jar. You want to be in the cookie jar as long as you can, so you're eating these entire cookies. When you get up into this area up here, this is just the crumbs. You're just trying to grab whatever you can off the top. this is where you make the most money. So the most ideal part is to find it, come through the sweet spot. Then when it gets into the overbought area, that's just cream on top. And you're just waiting for an exit point then.
That's our take on Microsoft. We will keep you updated on the stock as the year progresses, and certainly overvalued at the moment. And if it ever drops into our sweet spot as value investors, we'll be buyers of Microsoft
Absolutely.
one day for sure.
I'll be a buyer someday.
That's our thoughts. Fondle thumbs up. See you next video.